All right, let's get right into it. Today we're digging into a puzzle that is pretty much everyone in tech and finance scratching their heads. We're talking about the absolute tidal wave of money flooding into artificial intelligence. So, is this the next great gold rush, or are we watching a bubble that's just waiting to pop? Let's unpack it.
First, just to get a sense of scale, we are talking about more than $100 billion. That's what venture capitalists have pumped into AI startups in 2024 alone. It's a truly staggering amount of money, a massive bet on the future. But that's only one side of the coin.
Because then you see this number. A study from MIT found that 95% of organizations putting money into generative AI are seeing zero financial returns. Nothing. And this, right here, this is the paradox we're exploring today.
So we're calling this the AI investment paradox. You've got this world of massive, unbelievable hype on one side and a harsh reality of missing profits on the other. How can both of these things possibly be true at the same time?
And this is where that conflict just smacks you in the face. The hype machine is absolutely roaring. AI now makes up a third of all venture funding on the planet, and big tech is gearing up to spend $250 billion. But then you look at the reality on the ground, and it's a completely different story. Most of that money just isn't translating into returns. AI pilots are stalling out, and even the poster child of this whole boom, OpenAI, is reportedly losing billions of dollars.
What this paradox really tells us is that the market isn't one big thing. It's splitting right down the middle. So let's figure out who's actually winning in this environment. And, well, who's losing.
So who are the clear winners so far? It's the giants, the hyperscalers like Amazon, Microsoft, and Google. They're the ones providing the basic infrastructure, the digital picks and shovels that this entire AI gold rush is being built on. And their position is just incredibly dominant. They've already spun up a $20 billion revenue stream from AI, and that's projected to quintuple to over $100 billion in just 5 years. And their strategy is actually pretty simple. They sell the compute power, the APIs, and they weave AI into products that are already making them a ton of money, like Office 365 or Google Search. They can afford to play the long game.
But on the other side of that split, it's pretty much everyone else. And that includes a lot of the pure AI companies, even the big names you hear about constantly.
Just take a look at OpenAI, the company that gave us ChatGPT. They are projected to lose an incredible $8 billion in 2025. Yeah, they're making massive revenue, but their costs are even more massive. And you really have to ask yourself, if the market leader is struggling this much to make a profit, what does that say about everybody else?
And this gets us right to the heart of the problem. Why is profit so hard to come by? It really all boils down to the absolutely brutal economics of AI.
The term you need to know here is unsustainable unit economics. And what that means in plain English is this. For a lot of these AI companies, every single time a customer uses their product, asks a question, makes an image, the company actually loses money. The cost of all that computing power is just way higher than what they can charge for it.
And here's what that looks like in practice. A company could bring in a really impressive $100 million in revenue. But if it costs them $125 million in pure compute power to generate that revenue, they're still $25 million in the hole. The crazier part is, the more successful they become, the more users they get, the more money they lose. It's like a treadmill to bankruptcy.
And in some cases, it gets even more wild. I mean, just try to wrap your head around this. Some analyses suggest there are AI companies losing almost $40 for every single dollar in revenue they bring in. It shows you just how upside down the economics of this industry are right now.
Okay, so given this chaotic, frankly confusing environment, how is anyone supposed to think about this market? Well, the data actually points to a pretty clear framework for navigating the hype. Let's walk through what an investor's playbook could look like.
So what's the playbook? It really comes down to 4 simple steps. First, focus on those picks and shovels we talked about, the infrastructure players. Second, bet on companies that already have a profitable business and are just using AI to make it even better. Third, you have to demand a clear path to profit. Don't get swept up in the hype. And finally, be really, really careful with valuations. Right now, AI companies are trading at more than double the multiples of other tech companies, even though most of them aren't profitable. That's a huge red flag. So, this all brings us to the final question, the big verdict. When we look at the future of AI investment, what are we really seeing here? Is it a massive bubble, a painful correction on the horizon, or a genuine revolution?
You know, the parallels to the dot-com bubble are just impossible to ignore.
In the late 90s, the NASDAQ went through the roof, all fueled by internet companies that weren't making any money. Today, you see NVIDIA's stock doing something very similar, leading this AI boom. And we all know what happened next back then, a crash that wiped out all the weak players. The big question is, are we about to see history repeat itself?
And the verdict here is, well, it's a bit of both. Yes, parts of this market are without a doubt a bubble. Some of these valuations are completely disconnected from financial reality. But, and this is a huge but, just like the internet, the underlying technology is absolutely real. It's transformative. The internet survived the dot-com crash and changed everything. AI is very likely going to do the same.
And there's a great reason for that optimism. Look at this. In just 1 year, AI adoption inside companies has jumped from 55% to 78%. This isn't just talk. Organizations are actually putting this technology to work at an incredible pace, even if they're still figuring out the ROI. The underlying demand is definitely real. So a market correction, if it comes, shouldn't be seen as the end of AI. In fact, it's probably a healthy and necessary cleansing for the industry. It'll wash out the companies that don't have a real plan. It'll force valuations back down to sane levels, and most importantly, it's going to shift the whole industry's focus away from hype and toward building sustainable, profitable businesses. It's a move from just making promises to actually performing.
In the end, a potential crash is going to do what markets always do. It's going to separate the hype from the real. The business models that don't work will fail, and the companies that provide actual, tangible value will survive and probably thrive. And that leaves us with the trillion-dollar question. When all the dust settles, who is actually going to be left standing?